Hello, my name is Pat Cunningham. I'm with Macquarie here in New York, and I'm happy to be here today talking about infrastructure and talking about what our the perspectives are on infrastructure. So what I'd like to do is let's start out with our panel, just spending a minute or so introducing themselves and giving a little bit of focus, a position on where they are in the market, and obviously they're all very sophisticated infrastructure investors. And with that, we'll start with Vikram, right immediately on my left here, and then
Right.
we'll go with Mario, and then John Crocker at the end. John is in for his partner Frank Albrecht, who had a personal emergency, and Vikram from Credit Suisse is filling in for Maxime, who called yesterday midday with a personal issue at home. So Vikram.
Great, thanks, Pat. Vikram Bhaskar with the Customized Fund Investment Group at Credit Suisse. We are alternative fund of funds manager, and I lead the infrastructure effort within that platform. We manage about $2 billion of commitments to infrastructure, and we commit to infrastructure funds, but we also do infrastructure secondaries as well as infrastructure co-investments, and have been doing that as a dedicated effort since 2006. I've spent some time in the infrastructure space prior to joining Credit Suisse. Back when I was at Deutsche Bank, in fact, I was doing project finance over in Asia for a number of years, and have financed quite a few transactions in the project finance world on the debt side before I came over to Credit Suisse.
And Mario?
Sure. I'm Mario Miceli with TICREF. TICREF is a large insurance company as well as a retirement fund. We have about 450 billion under management, of which on a yearly basis we get a specific allocation to all sorts of different teams. My team is within the energy and infrastructure team. We have an allocation of about $1 billion a year to invest in those two verticals, meaning both the infrastructure and the energy, which for us really means also the commodity exposure. And as you can imagine, as an insurance company, we're a long-term investor. We have our investment is really going globally these days, and we diversify across regions and currencies. And just to give you a quick background on myself, I joined TIA in 2008. Prior to that, I was with JP Morgan and with Dresdner.
Yeah, my name's John Crocker. I'm with DB Private Equity. DB Private Equity entered the fund of funds business in the mid-90s, and we got into infrastructure about 2.5 years ago, as investors increasingly asked us if we had any product available to them. We're currently in the marketplace raising a fund of funds from European investors and looking for separate account business in the U.S. I've been involved in infrastructure since '06, both on the agency side and then more recently on the buy side.
And as I said, I'm Pat Cunningham with Macquarie. We are on the investment side. We're the largest infrastructure investor in the world, and we are in the division called Macquarie Infrastructure and Real Assets, and we have a team of over 300 people in 10 offices globally, and we have regionally based funds around the world. So to start out, why don't we just talk a little bit about why infrastructure is attractive, because each of the folks up on the panel today are very, very deep and very sophisticated in looking at infrastructure. So maybe we could just get a little bit of view as to why you spend time on infrastructure, what's attractive about it. And Vikram, maybe you could start and with relation to some of your clients that you manage money for.
Sure. And I think the one thing that I'll tell people right away is that different investors come into infrastructure for different reasons, and it's important to understand the characteristics of infrastructure and the fact that you can have different risk and different returns associated with those risks, and so you can actually create portfolios of infrastructure investments that give you different risk-return characteristics. I'll give you a couple of examples of what our clients are looking for. So our very first client looked at infrastructure as a proxy for fixed income. They essentially wanted high cash yield out of a fixed income or a bond-like approach. What they wanted to do was a very core infrastructure portfolio akin to real estate, focused on both equity and project finance within infrastructure, and they wanted somewhere between a 3 to 4% cash yield. That cash yield component to them was why they got into the asset class. The other investor on the other extreme, our most recent investor, in fact, got into the asset class largely to get into investments that were uncorrelated with the GDP, and to the extent possible get some inflation benefits or hedge in the infrastructure investment world. So very different reason for getting into the asset class. But again, I think constructing a portfolio appropriate for the reasons is what we tell our investors you should be doing. And again, if you look at what other investors have gotten to do in the asset class, it's because of long-term stable returns, as well as increasingly people looking for an inflation hedge.
Yeah, I think Vikram really summarized the reasons for our fund as well. Just to add to
Barry,
that.
I don't think you're getting off that easy.
Sorry.
You got to give a little answer.
Yeah,
we
of
want
course.
a little juice from you.
Just to add to that, for us is also obviously not only just the cash yield component, not only the inflation protection, not only the non-correlation, and we see that also with especially on the energy side, with our exposure to commodities, but also to invest across different currencies. And so within our team, we actually do not hedge any of our transactions. And one of the reasons is, as a fund, most of our investment till the past several years have been effectively 90+% US dollar denominated, so we want that extra diversification. So I think the reason for investment in infrastructure is really diversification across currencies, across different asset classes, and we're really seeing as this area for us to be one of those areas where our firm is going to grow significantly.
Yeah, I mean, I think the interesting thing about the infrastructure asset class is the potpourri of reasons why investors are actually looking at it. And that's indicative, I think, of the early stage with which investors have started to look at it, with obviously some players like the Canadians and the Australians being far more advanced than investors in many other areas. So you go down the litany, and part of this then relates to what are you putting in that infrastructure portfolio. So the guys who might be focused on inflation protection or liability asset matching are going to look at more core infrastructure. There are other people who are seemingly wanting a bit of a higher return, and you go across investor to investor. I think a lot of this is still, particularly in the U.S., in evolutionary form.
What are you guys seeing, and how do you define your infrastructure when you're looking at things? Whether how do you define it? Core plus? Where do you see that, and where do you see the value? John.
Well, I mean, again, if you're in the fund of funds business, you have an issue, because if you're looking at core, how do you apply your own fees?
Right.
And I think we've done some work on that where it's sort of reasonably backloaded, so we can do some core, but you need to do that within a framework of a core plus and some opportunistic. Again, it's what's going to match with what you want. And then if you're doing core, the question is, I mean, this then relates not only the investor, but how are you structuring these vehicles? And is infrastructure ideally in a private equity vehicle where, and maybe it is for opportunistic and core plus, but I would argue in core, given the characteristics of return, maybe a perpetual structure is the appropriate one.
I think that's I think that's a very hot topic. And Vikram, maybe could you just talk about a little bit about what your clients are looking at in terms of opportunistic, core plus, or core, and how you guys are seeing that fit into various portfolios?
Sure. I think the vast majority of our clients are looking for core to core plus risk and associated return. There's a handful of clients that are willing to take a more opportunistic approach, largely in a diversified portfolio. So, roughly a third across core plus, value add, as well as opportunistic. So we don't actually have a client that does 100% opportunistic infrastructure investments or energy investments for that matter. I think the key difference is the way we look at the risk is really first understanding that the risk a fund manager, a secondary portfolio, or a co-investment is taking, and then define it as core plus, a value add, or opportunistic for that matter. I don't think the industry is at a stage where we can clearly say a manager's core, at least in my opinion. Even core managers have done non-core deals or value add deals, and essentially take each deal or each fund manager on its own merits, making sure that we're getting the appropriate return for the risk that we are taking, whether it's a fund manager or a co-investment. But I think increasingly the reason that people are getting into the asset class associates itself largely with that core to value add segment of the market. The opportunistic segment, I think people are realizing it sort of crosses over between private equity, to John's point, between private equity and infrastructure. And I'd say, less than 20% of our clients actually want that opportunistic exposure. So it really is more the core plus value add. 80% of them would want that.
Well, let's take a step backwards and to look at the market in a little bit of a macro view. How would you all see the growth of infrastructure as an asset class within a portfolio diversification strategy? Do you see it growing along the same lines as, let's say, real estate did in the 80s and then private equity in the 90s? I speak to a lot of clients and a lot of investors, and their allocations are growing into the space, whether it's defined as real assets and infrastructure as part of the real assets bucket. But there's always that question of where does it fit? And so I would just throw this out to any of you to talk about just in general the market. Where is infrastructure growing? Is it coming of age and maturity the way private equity did and real estate before that? So anybody that wants to.
Let me tackle that. I guess within our fund, what we have is a real assets initiative, which really includes a series of different investment, from agricultural investment to timber to oil and gas to infrastructure. Strangely enough, real estate is not part of this initiative, but that's because we've been investing in real estate for a long time. On the real estate side, we have about I believe 16 billion under management at this point. On all the other initiatives, with the exception of timber, from a direct standpoint, just started right around 2007, 2008. I think where our firm is going is really we're looking to increase our allocation to the real assets initiative at a level in which we'll reach the same type of exposure that we would have on the real estate side.
John?
Yeah, I mean, I think it is coming into its own. Part of that is the evolution with a number of investors as to where they put it. You talk to Chris Beal at Alinda, and when he went out to raise his first fund, he thought he'd raise 500 million, and he showed up with 3 billion. But if you go through the list of investors he has on that first fund, he said most of them seem to come out of special situations or real estate. In his most recent fund, I'd say 50% of the investors are doing it out of defined allocations to infrastructure. I do think we'll go through an adjustment period because a number of investors entered the asset class during the market peak, and there are some players in infrastructure that have clearly overpaid and overlevered, and we've seen a number of examples of that. So some of those returns won't be there, or at least anticipated returns. But long term, the two fundamental drivers are, asset liability gap and a expectation that we're at the bottom or near the bottom in terms of inflation, and inflation will come back, and people want to guard against that.
Vikram, just on briefly on the clients, you have so much client interaction. How are clients seeing this? Are they talking to you about growing their infrastructure allocation along the lines that they did their private equity when you were doing that?
So, when we dedicated an investment team in 2006 to the asset class, we'd been investing in it for 2 or 3 years. We actually hadn't had a single inbound inquiry from a client asking us about infrastructure. And that was the case in 2006. That was the case in 2007. So it was us marketing to investors saying, this is infrastructure, this is a new asset class. At this point, virtually every week or every day, we have new investors coming to us saying, either we want to learn about infrastructure, or we want to commit to infrastructure, or we've done something in infrastructure that we don't understand, can you help us, right? Those are sort of the conversations that we are having. Virtually every large investor, if you take the 50 largest investors in the world, again, this is me plucking a number from the air, I would bet over 80% have an allocation or have invested in infrastructure. If you go down to the next tier, I would bet you 80% of them are either have put in place or are in the position of putting in place an infrastructure allocation. And then if you go to the smaller end of the market, I think everybody's heard about it now. I think the question for the asset class is it going to deliver on its promise? And if it does, over the next 5 to 10 years, it's there to stay for the long term, in my view. So it really is for the industry as a whole to make sure that we deliver what we say we are going to do in the asset class. And if that's the case, then that allocation is here to stay.
Thank you. Yes, John.
Yeah, I think one of the differentiators is going to be in the evolution of the asset class is the number of large investors who decide to go direct. And part of that may be the mismatch in fees to the underlying assets, i.e. taking a private equity structure and applying it to core plus and the returns associated with that. But I do think anybody who's large, again, comes back to the ability to buy assets that provide perpetual return and inflation protection. And so if you're a big fund and you have the infrastructure and the capability to go direct, or at least play directly with other players, we'll see that segment of the market probably grow faster relative to the infrastructure asset class than private equity or a real estate. And part of that has to do with the lumpiness of the underlying assets, right. Which is, there are only so many New Jersey turnpikes type of thing.
Well, let's zero in a little bit more on that, and we'll put the spotlight on Mario. Mario, in terms of direct investing, you're one of the people that's out there in front in the market, and maybe you could just talk about generally some of the things that you're seeing. You look at funds, you look at directs, just some of the exciting things that you see in directs, whether it be directly into investments or co-investments alongside GPs.
Sure. I guess just maybe as a way of background, just to be helpful to explain what has happened, like how a firm has transitioned in the past few years. So as of 2007, 2008, we actually started having a direct allocation to all those different asset classes, including energy and infrastructure. By doing so, we're effectively taking away some of the allocations that we would give to fund investing, as well as some of the other debt opportunities, and we brought into this other asset class, which is the real asset group, where we looking to do effectively about 80 to 90% into direct or quasi-direct type of initiatives. And so the way in which we're doing this, again, we're still growing. Our team is today about 8 people, so we're still pretty small. We definitely need the help of others to succeed. And so the way in which the strategy has moved has been in a way in which we're using funds as a way of more like partners in to creating like more proprietary deal flow, as well as other developers to do the same. So a couple of transactions that we've done in the past have been focusing right around that. So we recently did a transaction with Edison International in the wind space, and so we put a commitment of about $400 million to developing that wind portfolio. We've done something similar with Hunt on the transmission side of things, where we commit about $450 million into the transmission space. And then with some of our fund relationships that we've had and where we've seen co-investments coming out of those funds, where we'll continue to make investment in the future in future funds that they might be raising.
Now, to go from the macro down to a little bit of micro view on this, what are your thoughts on inflation over the next 5 years, 10 years, and do you see a real assets and infrastructure portfolio of investments? Do you see that as helping, or just being a way to tread water, or do you see that as helping as a real hedge against inflation risks? John?
I'm not sure I can predict whether inflation is going to come or when it's going to come, but clearly we're going through a period where there's massive liquidity being pumped into the marketplace, and at least if I remember economics 10, but not very well, at some point you pay the piper. So there obviously will be some increased inflation, and I think it's a concern to everyone. It's also, part of that.
John, with that answer, I feel like I'm at one of those presidential debates. With that answer, that was a non-answer.
I mean, clearly, I think most of the investors we talk to are concerned about it, and it's on their mind. And certainly, you look at some of the, again, coming back to the core infrastructure investments. I love to I don't want to pick on New Jersey, but the replacement cost of New Jersey Turnpike will always be greater than the rate of inflation per se, or could be.
Right.
Now, maybe the yield goes down for the first time, but I think that's the question. What people are looking for is where they can get that exposure.
What about geographies? What are you guys looking at in terms of geographies for infrastructure? At Macquarie, we're very, very involved right now in Asia. We're about to launch a North American fund, which we think is was just in the press recently, and we're also heading toward closing a European fund, which has been very successful for us. So we see our focus is global, but how do you see the market in terms of this, Vikram?
Sure. Let me actually just answer the earlier question first. I want to go back to inflation. While I agree with John, I can't predict when inflation is going to come. I think sooner or later, take a time frame, it will be there. My view on infrastructure versus other real assets for inflation, if you want a better inflation hedge, our view has been that you stick with the commodities, oil and gas, where you're getting the commodity exposure, where you're getting a more pure inflation hedge. Infrastructure, depending on the transaction, depending on what you're doing, can have characteristics that can hedge inflation. I would argue, maybe a third of the portfolio will have some form of inflation hedge, but that inflation hedge is not perfect, and I think investors need to understand that before getting into the asset class. So our bet for inflation hedge is more focused on other real assets rather than infrastructure, and infrastructure certainly helps, but it's not there just to hedge inflation for our clients. In terms of our approach to investments, while it is global, our focus for the last, let's say, 4 to 5 years, maybe 6 years, has been in the U.S., North America, as well as Europe. Emerging markets, while we've looked at every fund, we've looked at a number of secondaries and co-investments, our view today is for the risk that you're taking, you aren't getting the return. I think the risks in emerging markets are understated, and there's a tendency to believe that you need infrastructure in emerging markets. That's where the infrastructure spend is going to be, and therefore they're great investments because there's this sort of demand-supply mismatch in emerging markets. Our view today is, given what's happening with budgets, given what's happening with strategics in the Western world or the OECD world, you can get sort of similar, rates of return, but frankly not taking any other emerging market risk. So while we look at emerging markets, we have not made a emerging market commitment since 2006, 2007. But we still look, and if that changes, we will commit. But at least as of now, it's a 0 to 10% allocation to emerging markets, whether that be Asia, LATAM, Africa,
right.
MENA, whatever that is.
Mario, any view on this?
Yeah, actually, I tend to concur with Vikram. Funny enough, I think our last investment in Brazil was in 2007. Since then, we looked at several opportunities down there, but we just found them to be extremely expensive. So we feel like we've gone backwards and really focusing on North America. And just recently, we're starting to look at Europe again.
To come to a little close, where do you see the most interesting opportunities in infrastructure, just generally, as a way to end up? And then if we have time for 1 or 2 questions, if we can, maybe we'll do it. But John, where do you see the most interesting area of infrastructure?
I mean, I actually think it goes back to, since we're looking at fund managers, looking at how they purchase those assets and what type of leverage they're planning to put on those assets. And how disciplined and what value add they add after they own those assets, if they can add some value. So,
Mario, okay, I'm sorry, I didn't mean to.
No,
Mario,
that's it.
But that clock is going negative
I know.
on me up there. So, Mario, best area you think?
Well, as I was mentioning earlier, I think we're probably going to stick with North America for the most part. Probably the majority of what we'll do is going to be in energy.
Yeah, from a sector perspective, energy and social infrastructure probably in the near term continue to be the most interesting. And that's sort of 60% of what we are looking at right now.
All right, thank you. Do we have time for 1 question? One, I'm taking that as a yes, even though you shook it this way. Does anyone have a question for any of our, Andrew?
Yeah, the general partners have a pretty big hurdle rate, and we're observing that they're tending to do value-add opportunistic deals even before funds to get into their carry. Have you guys thought about that?
Yep, I mean, it's an issue. It comes back to sort of what are the terms, and we started out with a private equity framework, and is that really the right structure given the match with what investors want? So if you're value add, yeah, you can get away, you can structure yourself that way, but I don't think that applies across the spectrum. And I mean, we've seen this with the failure of Blackstone to raise a infrastructure fund, and KKR cutting their prices to try to raise an infrastructure fund. So the pressure on fees is discussed on the LP side all the time.
Yeah, no, I agree with you, Andrew, that I think apart from them trying to hit the hurdle, there's also this concept of infrastructure, in 2005, 2006, was sold as a homogeneous asset class. It's a toll road, there is no difference, you'll always make money in it, it'll always be there. The Australians can't take it away, et cetera, but the reality is a lot of what was considered core, or rather sold as core infrastructure, wasn't core infrastructure, and you've got to look at it on a case-by-case basis. I will say that most of the GPs that we see today, with the exception of 1 or 2, have actually gone through the cycle where they're a lot more honest with what they are willing to do and what they're promising. And I think for the long term, The GPs are here to stay. We actually, we invest with them. There's still some that we will not invest with, but for the most part, we have seen that change from 2008 and previously, and clearly what's happened in the interim has made them a little bit more honest. We buy a lot of the funds that you're talking about that are trying to hit that hurdle in the secondary market. And in the secondary market, we have the advantage of actually looking through and saying, they've got 20% of the dry powder left or 30% left. How much do I haircut it on the price so that I make sure I'm paying the appropriate price? But we are seeing that with funds that are underwater, with funds that frankly, did core deals, over-levered them, and now are trying to play catch-up because they've had a couple of losses, which frankly they shouldn't have had. But as a general matter, I think the GP community is a lot more honest to what they promised today than they were, 5 years ago.
Well, thank you. I'd like to thank Vikram and Mario and John because I think we really have a very, very deep, talented panel. And thank you all for spending the time with us this afternoon. Thank you.
Great. Thank you.